Canada just crushed its job expectations. The Bank of Canada is now questioning whether they should be measuring inflation in the way that they do. Oh my gosh. Here's what both those things mean for you and your mortgage strategy. Welcome back, guys. It's Alex McFadden of The Flow Mortgage Co. And if you're listening to this podcast or YouTube, I want you to do two things: subscribe, hit the like button, and share it with a friend. Let's get into it. Friday's job report added 60,400 jobs when economists only expected 5,000. Honestly, you probably don't even care about that, but let's talk about the stuff that you do care about. This is actually good for the economy, but it kind of throws a wrench into rate expectations. So the numbers were really clear. 60,400 jobs added. They expected 5,000, and the October 29th rate drop just dropped from 70% odds to 53% odds, just like that overnight. But here's what makes it actually pretty interesting if you think about it. While the markets are debating whether we get one more rate cut or not, the Bank of Canada just revealed some massively interesting news, which is that they're questioning whether or not their entire approach to measuring inflation, which they've been doing for a long time the way they have, specifically as it relates to mortgage interest costs, should even be in those calculations. That's crazy. This is like a fundamental change to why and how rates are set. So let me be clear. What happened last week on Friday? What did actually change? So first of all, variable rate holders might still get the one rate cut that they're looking for, 0.25%. There's still 53% chance odds on October 29th. But the multiple rate cuts that were being suggested or proposed, those are currently right now off the table. This isn't permanent. This is currently off the table. Now, prime today is sitting at 4.7%. If there was another cut, that would bring us down to 4.45. I think everybody with a variable rate and line of credit is hoping that that is the case. But we've just jumped down to basically a coin flip odds of the likeliest of that happening. And for fixed interest rates, which moves based on the bond yields, not the bond rate, the bond yields, Friday's strong job data basically bumped those numbers up a little bit. I mean, we were up 7 basis points in one day, which suggested that fixed rates, according to the markets, not according to Alex, but according to the markets, probably a bottom. They're probably, relatively speaking, close to the bottom, unless something else significant happens. So what actually changed on Friday? Like that's what's important that everybody wants to know. Let's break down the jobs report and what it actually means for different types of mortgage products, because variable and fixed, they both move for completely different reasons. Canada added the 60,000 jobs versus the 5,000. That's 12x the amount of expectations, which most important factor here is that people with full-time jobs, basically 25 or older, those are the primary people that have mortgages, jumped to 105,000. Right? That's a big freaking deal, which was a reverse from August's 29,000 job loss. Now, does this continue? I don't know, but this is a big factor right now. Unemployment stays the same at 7.1%, even with all these jobs, because there's 72,000 people entering the labor force. Manufacturing, which is really interesting, added 27,800 jobs since January. And wage growth, which means like the increase of what you're earning, it held steady at 3.6%. That's a lot of data, a lot of numbers. Let's get into some real points and talk about what this all means. So the market, it reacted pretty quickly, basically. The Bank of Canada's odds, which is the likelihood if they cut interest rates, it went down from a 7 out of 10 chance to a 50% chance, which again, it's going to affect the potential of variable rates since it's a coin flip chance now. Separately speaking, but with a similar reaction, the 5-year government bond yield, which determines fixed mortgage rates as a rule or in general, lags usually about 1 to 2 weeks behind. It jumped 7 basis points, with fixed rates currently hovering around 4.09% on average, depending on the amortization. The term could be higher, could be lower. That 7 basis points in bonds, it kind of suggests that the fixed rates are probably not dropping any further at this point right now. I mean, things could change next week, but as of right now, that's where it's at. And this is where things get pretty interesting. If you want to understand the bigger picture of what's actually happening economically with the Bank of Canada, which I think you probably do if you have a mortgage in Canada, you want to know this stuff. Last week, this guy who you've never heard of before, Deputy Governor Rhys Mendes, gave a speech that basically admitted Canada's inflation measurement has a massive problem. That's what he says. Mortgage interest costs are distorting their inflation readings. This really matters. This is a pretty big deal. Like, you got to know this stuff. Canada is unique in the G7. We include mortgage interest costs in our CPI, which is our consumer price index, which basically means when the bank raises rates, mortgage costs go up, which means that CPI goes up, which looks like inflation because it kind of is at the end of the day. But anyways, Mendes said their preferred core measures are CPI trim and median, which in English means they're supposed to filter out these types of volatilities, and it's failing to do that right now. So basically, the bank's saying, we failed. We want to get rid of what we're doing now and change it up, do something different. Whether you agree with this or not, that's what they're saying. But here's the kicker. They described, quote unquote, underlying inflation as a concept, not a statistical measure, which they're saying basically inflation is more of a feeling. And then immediately after that, they used it as a stat to justify the recent rate decision. So I don't know what these guys are talking about here, but there's some interesting conversations going on behind the scenes. And I think they're even confused about what they're saying. Why am I even telling you this stuff? Why do you even care to hear this stuff? Because if the Bank of Canada is questioning their own inflation measurement framework, it basically means that future rate decisions are going to be even more uncertain than usual, which is wild because there's already like a lack of certainty. They don't project it until like 5 days beforehand. So what does this mean for your mortgage decision? Because at the end of the day, all you guys care about here is, what does this mean for me or my clients if I'm in the real estate space? All right, let's bring this back to practical decisions. You've got job data projecting fewer cuts, and you've got a central bank questioning its own decision framework. This is what it means for your mortgage. If you're a variable rate holder, you're probably going to get at least a quarter more point cut. If the October 29th meeting goes your way, then that brings you down from 4.95 to 4.7% on a $500K mortgage. That's like $65K in $65 a month in payment relief, depending on what your amortization schedule is. This matters because it gives you, there's still remaining upside on a variable rate mortgage, but the likelihood or the possibility of multiple cuts being on the table from a month ago, taking prime down to like 4.2 or 4% or 3.95, I suppose, those are kind of what they're talking about off the table after Friday's job report. And now the best case scenario is one cut and done. And this is how fast this data changes. This is why them talking about making a decision like this is massive. Remember, just as quickly as we got this news, we could flip-flop in 30 days later. So just keep this in mind with all this information. If you're a fixed rate shopper and you see a 5-year fix between 4.09 to 4.29, with the 5-year government bond yield jumping up 7 basis points on Friday, that the chances are that rate's not going to likely drop much further, at least based on today's data. If you're waiting for 3.75 or 3.85, Friday might have just slammed that window shut and said, you've got a great option, take it right now. But you want to know the math, fixed or variable right now. You can lock in at roughly, again, 4.09 to 4.29. Take it, up or down, depending on your situation. Or you could take a variable rate at around 4.2% right now, with a quarter point rate cut potentially coming. If you get that one rate cut and it stays flat for the 5 years, the variable rate wins. It saves you about $3,000 on the 500, and that's about $50 per month. But if the BOC doesn't cut, or if they have to raise rates again in the near future because inflation comes back, then you would lose. Given the uncertainty around this decision right now, the fixed rate in this hypothetical scenario at 4.09% is kind of looking more attractive than it has for a while. But I'll be really clear with you. The data just flip-flop in 30 days. It could flip-flop the other way as well. So if the chances are we cut twice, guess what? You're in favor of the variable rate mortgage all over again. But let's talk about the scenarios that actually matter. Let's walk through these scenarios that you're facing, because I think this probably helps to clarify your decision. Number one, best case scenario for variable mortgage rates. BOC cuts October 29th, bringing prime down to 4.45%. Pauses, let's say for 8 to 12 months, maybe a year. Your variable rate sits somewhere around 3.9 to 3.95%, again, depending on your discount, while your fixed rate sat between 4.09, let's just say 4.09, best case scenario. You save about $3,000 over the course of the next 5 years. Scenario number two, BOC doesn't cut again. They hold. Nobody wants that. They hold. Variable rate stays around the same, 4 to 4.2%. You're paying about 11 basis points more than a fixed. Now, again, there's some variance here because there are some variable rates that are similar to fixed depending on your situation. But anyways, let's just say you're 11 basis points higher. That costs you about $1,500. However, the upside of the variable, you still have that minimum prepayment penalty. You only have to pay 3 months of interest if you want to refinance or get out. So do not forget that when you're making these decisions. Scenario number 3, BOC realizes their inflation measurement is broken because they've had this come to, you know what, moment, and inflation comes back. They have to raise rates again. They go to prime goes to 5.45% or higher. Now you're paying significantly more than fixed in that scenario. Scenario number 4, the economy weakens dramatically. BOC cuts multiple times despite Friday's job report because let's say the next job report comes in even weaker. This is the big scenario where variable wins. And depending on whether or not Friday's job data was a mirage or that's like a new trend, it's not the most likely right now, but it could be the most likely in a month. So again, that depends on you. So 4 different scenarios, and each one has a different risk or reward. You're taking payment uncertainty to maybe save $50 a month in the best case scenario, but you're risking larger losses if the BOC has to reverse course. So here's an interesting data point that shows how wealthy Canadians are thinking about this rate environment right now, because you are a wealthy Canadian or you want to be a wealthy Canadian. Canadians' wealthiest quintile increased this is blow your mind. Get this. They increased their net worth by 4.9% in 2025. But here's the key information. Their financial assets grew 9.6%, while their mortgage debt only grew 1.9%. Woo. They are deleveraging, some of them at least, in real estate while building financial asset portfolios. That suggests they don't believe in real estate as appreciation environment in Canada. Now, we should always be clear that many of them are investing internationally in real estate. So let's be very conscious and clear on that. And they're not divesting completely, but it is something to be aware of. Meanwhile, households age 55 plus increased their mortgage debt by over 8% year over year. StatsCan thinks they're buying investment properties or maybe they're helping their kids with down payment money. There is a play to be had there if done correctly. So here's the key takeaway out of that. The most financially sophisticated Canadians are reducing mortgage leverage and building up more liquid portfolios, which it's probably a good scenario in general when rate certainty is low and the BOC is questioning its own measurement framework. This doesn't mean that real estate is a bad buy. This means you need to be more careful and more clear and watch what rich people are doing. They are still buying, but not as much and not as much in Canada. So what do you actually do based on all this data is really what it comes down to, because at the end of the day, this is all talk unless there's something that comes with this. And what am I doing is a big question. Everybody's asking that, but let's talk about what you should do. So here's what you need to do based on this information. If you're shopping for a mortgage right now, remember 3 things. Number 1, the fixed rate market is generally speaking it is very similar across the board. There isn't a lot of variance. There's like a quarter point variance from one to the next, depending on the type of product feature. So number 1, nail down your plan, your strategy, your timeline, and what types of things you're okay to give up. The penalty, the features, the lender. What are the things that you're willing not to have? Because I look at it like insurance. If you're going to get a mortgage and you pay a higher rate, then you should be getting something more for that. Like, what is the benefit? Well, I pay a higher rate because there's lower prepayment penalties if I leave. That is great. So then you know what you're getting, right? So let's say you figured that out. You know you're shopping for a 5 years fix between 4.09 to 4.29%. And let's say, and again, this is assuming an owner-occupied home, insurable, 25-year amortization. That's probably going to be relatively close, unless something changes, the lowest that we're going to see for some while, unless something significant changes. Yes, there are lower rates for unique scenarios out there. I'm talking about the average situation. But based on this information, essentially, we're not likely to see rates go down in the near term based on that information. If you got a rate hold expiring soon, make your decision quickly. Lenders are going to reprice their rates after next week, and I wouldn't be shocked to see rates go up 0.05 to 0.1% in the coming 7 to 10 days. Or by the next time you listen to this, rates may have already come up. If you're in the variable rate market and you're hoping for more rate cuts, I would adjust my expectations and be prepared for only one rate cut. If it makes sense for you with that, then you can continue. If you do not think it makes sense with one potential rate cut, then go with the fixed if that makes sense, unless you're doing it for flexibility purposes or something else. And if you're coming up for renewal, I would not be the person waiting for dramatically better rates in this type of environment. With the uncertainty we've seen, I mean, I think certainty for a lot of people would be impactful. Basically, like if the market is suggesting that this is the environment that we're going to be in, or the lowest that we're going to be in for the next foreseeable future, and the projections basically, if I could display it, but the projections are basically showing from a market perspective that fixed rates probably go up about 0.25%. So flat or up for the next 12 months, then it means that we're probably at something like a bottom, unless something else significant happens, which it could. But that's where it is right now. And lastly, what I would do is I would pay attention to the Bank of Canada's 2026 framework. What are they going to do when it comes to making those decisions? If they change how they measure inflation, it could create a massive change in rate expectations. Until then, and as much as I like to report as best we can, assume you're going to get a crazy amount of uncertainty, and you should prioritize certainty in your mortgage decision if that is the most important thing for you. And that is why Friday's job report changed the game, but not in the way that most people think. With variable rate mortgage holders getting at least one more cut at most and fixed rates likely bottom out, the Bank of Canada basically admitted that their inflation measurement is flawed and messed up, and that's what they're saying. You've got to reconsider what exactly you do. The sophisticated money, this is the big money, the guys that are out there with billions of dollars, is deleveraging and building financial portfolios, not everywhere, but in some cases, or they're looking for more commercial or multiplex assets. It basically suggests that betting on the real estate boom, they're not betting on a real estate boom right now. They're confident, and they're not confident, I should say, that rates are going to go significantly lower. My feedback to you is if you have a mortgage right now, make your decision based on today's reality, not on tomorrow. Create the certainty that you need in your life today based on what you'd be happy with right now. If you found this information helpful, I said this before, save it, share it, screenshot it, whatever you want. Send me a message on Instagram and I'll send you my prepare variable versus fixed framework. Just type in the keyword prepare. And if you want to work together, click the link in the comments so we can make sure to help you out. Thank you so much. We'll see you on the next one.